At the moment, we're at an absolutely fascinating juncture with global markets, and particularly the US, where the S&P 500 is currently at a recovery high. And yet, at the beginning of this year, all the talk was of imminent recession. Here we are in the middle of the year, and now the talk is of a soft landing or no recession at all. So people are wondering, what's going on? And I think one of the key charts that I've seen over the last 2 to 3 weeks has actually come from Deutsche Bank, which looks at the timing of prior recessions and the lag between the recession and the onset of rate hikes. And whilst we're talking about no recessions potentially on the horizon, actually what this chart or this research would suggest is that it's still very much in the foreground. Out of the last 13 examples of recessions post an episode of tightening, in terms of timing relative to where we are today, only one of those, 1980, occurred sooner than we are at this current moment. In fact, on average, they were 19 months after the first instance of tightening. And here we are about 16 to 17 months. And the majority of those recessions all happened within effectively the next 12 months, so very much ahead of us, with perhaps 3 or 4 of them, as we can see on this chart, really approaching maybe in the next 2 quarters, but certainly the bunch of them over the next 12 to 24 months. So based on that research and based on the lag between the first rate hike and where we are today, that recession should still be ahead of us. And that creates a bit of a conundrum, because here we are in an environment where certain parts of the economy do look quite weak. We have seen manufacturing very much in contraction territory, but not necessarily recession territory yet. And at the same time, things like non-manufacturing, so the service sector, has been in relatively rude health. In fact, it's been in expansion territory for some time. Similarly, we're seeing a disparity between what we've got in the US, which is relatively robust, and we're seeing revisions to past GDP to the upside. And yet we've seen things like German manufacturing very much in recessionary territory, below 40. So not just below 50, but below 40. So we've seen global manufacturing appears to be in a recession. We've seen this sort of thing before. 2015 was a global manufacturing recession without an actual recession. We did see ISM below 50, but we didn't see across the country recession at that time. Now, a lot of the problems for the world has come from China, in that the China reopening has not been as emphatic as people expected. And whilst they have provided liquidity, they've been focusing that liquidity on the domestic economy and propping up some of the troubled areas such as property and the banks, rather than just growing things and building things, which is what we were used to before, which drove a lot of the commodity prices in previous years and decades. And then it comes to what the policymakers do, because the real difficulty here is second guessing where they should go. You may recall that the market has consistently been pricing a pivot. Now, if that's a pivot of interest rates going up and then coming back down, but that pivot just shifts out and out and out, well, that's actually a plateau. We're here in this scenario currently where CPI is rolling over. It looks like it could go to 0. Now, headline CPI is certainly rolling over much faster than core CPI, which is a bit stickier and the bit that the policymakers will really care about. But nonetheless, when we look at things like M2 year on year, which has gone deep into negative territory, people are saying, well, CPI should go negative too. But one word of caution there, because we've seen with M2 that the vast increase year on year that we got over the last few years should have equated to double-digit CPI, and it didn't. So we've seen an overshoot of M2 or an undershoot of CPI relative to M2. There's no reason why we shouldn't expect the same on the opposite direction, i.e. don't look for CPI to match what we're seeing with M2. So we should be a little bit cautious about that. But at the same time, CPI is very lagging. So yes, it is heading towards 0 in the US, but at the same time, we've seen a recent breakout in things like WTI, so crude oil. And WTI does roughly map onto CPI. So if WTI breaks out and squeezes higher, then we should expect CPI to follow suit. And so the conundrum, therefore, is, will policymakers be able to pivot? Will they be on hold? Or if we're seeing strength in equity markets, we're seeing upward revisions in GDP, and more importantly, we're seeing unemployment, which remains very, very tight. Actually, isn't the next move still in favour of a rate hike rather than a rate cut? Because over the last 20 years, we've all been complaining about how the Fed has been too close to the zero bound, how they've had no room to cut when a recession has arrived. And so even if CPI is at 0, but all these other elements are showing strength, surely they will want to at least hold where they are. They might want to pause, but are unlikely to pivot back into cuts. And what really matters here, as I've just mentioned, is what happens with unemployment. See, we're all looking for recessions, but actually recessions are defined by unemployment going up. Every single recession in the US has been accompanied by higher unemployment. And at the moment, unemployment is close to record lows. Now, there are some cracks starting to appear. When we look at things like initial jobless claims, that has started to turn up. But if we again look historically, initial jobless claims turns up well in advance of a recession. So the recession should still be ahead of us, but how far ahead of us is still very uncertain, and sequencing is what matters. Because we're in this scenario where if we get a recession, you should expect equities to roll over. Again, during every single recession since the war, we've seen a tradable low in the S&P either during or after each and every single recession, with only really 1982 showing a low that was higher than the previous low of the previous recession. Otherwise, we've always seen a major low in all of those recessionary periods. And the other element we've got to look at is yields. If we get a recession, yields should start to fall. We're not yet in a recession. We're revising higher past GDP, and we're seeing an equity market that's relatively strong and unemployment that's relatively tight. So what is likely to see unemployment rise? Well, a lot of this is the financialization of the market. As equities rise, big corporates tend to hoard employees. They don't want to shed them. So as long as the equity market is doing well, unemployment is likely to remain relatively low, relatively tight. It might not be strong because real wages themselves are relatively weak, but the unemployment scenario looks relatively tight, and it might need the Fed to break the equity market in order to see unemployment pick up, because although CPI is rolling over, everybody is well aware that whether it's a 1940s style inflation or the 1970s style inflation, we got recurring peaks, 3 recurring peaks of inflation. So far we've had one, and policymakers won't want to see recurring peaks this time round, or they'll be very, very wary of it. So we're in this very, very uncertain situation where yields could go higher, and positioning is long. When we look at the JP Morgan survey of asset managers, they are long. When we look at the futures positioning, this is the non-commercial speculative positioning. Yes, they're short, but a lot of these are hedge funds who've become market makers, who are therefore using these positions to hedge out other scenarios. All these are short futures against long cash basis trades, or sometimes short futures against credit. So that short futures position is probably not as real as the long positioning we're seeing with asset managers. So if yields start to break higher, there is a risk that positioning could be washed out and they'd have to sell out of those positions. We've also got about 1.9 trillion of issuance coming by the end of this year, according to cross-border capital. We have to be wary that this issuance is coming at a time when liquidity has been drying up. And Japan is also getting in on the act, because the Bank of Japan has just released itself from its yield curve cap at 50 basis points. It's allowing it to rise to 1%. Whilst this should put some downward pressure on global bond markets, the fact is that in the US, the yield uptick between the US and Japan was offset by the cost of hedging. So for a lot of investors in Japan, this new move to high yield doesn't make Japanese bonds that much more exciting, but slightly more so at the margin. But we have seen the Bank of Japan also coming in to at least control that move potentially to the new yield curve cap of 1%. So what can people do? And this is where it becomes quite tricky, because we've been used to these markets grinding higher, and people will be very wary of missing out. There is this fear of missing out that markets could make new highs. There are credible stories for this being a new bull market that goes on into next year, but there's also credible stories as to why this is now very, very overstretched. Now, there's 2 ways you can look at that through the options market. You could want to hedge yourself by buying puts against a long equity holding. And according to research by Goldman Sachs, 12-month puts on the S&P are the lowest that they've ever been in history. So they are relatively cheap. But the problem with buying puts is if you buy a put and the market keeps on going higher, you then have to re-hedge your put. You have to put it back to a higher strike to make sure you're close enough to the money to give yourself protection. But let's say you're long equities. What you could do is stock replace. That means that you'd sell out of your equity position into cash and then spend a little bit of that money on a reasonably long-term call option, which gives you exposure to the upside. That way, if the market continues to rally, you do have a bit of skin in the game. You won't get the full exposure to the upside, so you will underperform, but if the markets race away, you still got your call option in there. However, if the market then rolls over, you're long cash. Hopefully you put that cash into a safe money market fund or a safe bank where you can get a decent yield, and you've got your cash in hand to buy into that dip. You've got your powder dry and waiting. Now, again, we have no idea. We've been waiting for the recession. We've been waiting for a roller over in equity markets for some time. But this is a good way to be able to manage some of that risk. Because remember, when you're talking about hedging, if you hedge when you think you have to because things are rolling over already, implied volatility, what you're paying for your options, whether they be puts or calls, will already have moved against you and it becomes expensive. What you want to do is make sure that you hedge and you reduce your risk when things are in your favor. That's when the markets are still rallying and volatility is relatively low. And if we look at seasonality on volatility, and seasonality is often a little bit of one of those things which can give us a false sense of security. But when we look at volatility historically, we can see that historically it normally bottoms. This is implied volatility in around July and August, and then moves higher. Now, these numbers are distorted because of things like 2008, where we got that massive increase in volatility in September and October of that year. And although these numbers do basically post the 1987 crash, again, if we're going back long enough, the 1987 crash, which was in October, would again skew that volatility in the second half of the year. But nonetheless, it would appear that we are at an era or a period of low volatility. We've had a fantastic run in equities. Historically, it would suggest that based on the lag between interest rate hikes and recessions, the bulk of all recessionary experiences are still ahead of us. Therefore, the chances are that if we're going to have a recession, well, obviously, it's got to be ahead of us, but that would be very, very normal and not unusual. This could therefore still be a window, but a window in which things look good, and the Fed may still need to tighten if equities remain strong, unemployment remains tight, and yields start to break up and go higher. So the risks are that maybe the Fed themselves are the one that have to break the back of the equity market, to break the back of the unemployment market, to make sure that we don't get recurring levels of inflation, even though currently inflation, which is lagging, is heading lower. So one thing to think about, stock replacement, keeps some skin in the game, reduces your risk profile, and gives you that dry powder so that if we do get that rollover, you can buy into it and you don't have to worry too much about the timing.